Welcome to the deep dive. If you've been keeping an eye on the markets lately, well, you can almost feel the tension in the air, right?
Definitely.
There's a real sense of waiting.
Exactly. Everyone is just incredibly focused on every whisper of upcoming economic data. There's this palpable sense of anticipation. And our mission here, as always, is to try and cut through all that noise.
Yeah.
We're here to deliver you the most important insights, give you the tools to understand what's really moving the needle, and, hopefully even make you chuckle a bit along the way.
Always good.
The past week has been incredibly dynamic, a real roller coaster, actually. It's perfectly set the stage for even more crucial developments just around the corner.
Okay.
So, hey, let's unpack this.
Absolutely. And to help us navigate these, well, intriguing, sometimes choppy waters, we've pulled together a focused collection of reports. These basically detail last week's market movements and offer a forward look at the critical economic calendar for this coming week, September 8th through the 12th, 2025.
Our goal in this deep dive is really to give you a shortcut to being well-informed, help you understand the underlying currents shaping the market. It's not just about what happened, but why it happened, and what that might mean for you as you consider your next steps.
Right. And before we jump into the details, a quick but very important note. This deep dive is created solely for educational purposes.
Crucial point.
It should never, ever be considered financial advice. We always encourage all of you listening to conduct your own thorough research or, even better, consult a licensed financial professional before making any investment decision.
Please do.
Your financial well-being is paramount, so always do your due diligence. Okay,
Well said.
now let's really dive into the single biggest catalyst that dominated headlines and set the market tone last week, the August jobs report.
Ah, yes, the big one.
This report, specifically the non-farm payrolls, which gives us that broad look at employment trends across most industries, minus farming and some government jobs. Well, it revealed that the U.S. economy added a mere 22,000 jobs in August.
Just 22,000.
Yeah, and to put that into sharp perspective, it dramatically underperformed the expected, what was it, around 75,000 jobs?
Yeah, the consensus was about 75,000.
So that's not just a miss, that's a significant miss. Less than a third of what was anticipated.
It truly was. And the market's immediate read on that weak number was quite clear. It immediately raised alarms about potential labor market weakness.
Right.
Think about it. Fewer jobs added suggests a softening economy. And what happens when the economy softens?
Fed speculation ramps up.
Exactly. Increased speculation about the Federal Reserve's next move. For instance, the probability of a substantial 50 basis point rate cut in September, that's half a percentage point, a pretty big move. It shot up to approximately 14%.
Okay, 14%, so not a guarantee, but a definite shift.
Precisely. While 14% might not sound huge on its own, it reflects a rapid shift in sentiment. It essentially signaled that investors were starting to price in a more aggressive easing cycle from the Fed.
So if we connect this to the bigger picture, it sounds like these job numbers really solidified things for investors. They were maybe already leaning towards the Fed loosening policy.
I think so. This wasn't happening in a vacuum, right?
Right. What else was going on?
Well, this weak jobs report landed alongside another key piece of intelligence from the Fed itself, the Beige book report.
Ah, the Beige book. Always an interesting read.
It is. And for those less familiar, the Beige book is basically an anecdotal summary of economic conditions compiled by each of the 12 Fed banks. It's based on info from business contents, economists across their districts.
Got it.
In this particular report, economic activity and employment were described as, quote, mostly unchanged. But here's the critical detail. It also highlighted how tariffs and policy uncertainty were actively weighing on households and businesses.
Okay, so uncertainty was a key theme.
Definitely. So when you combine the surprisingly weak jobs data with the Beige book's cautious tone and that direct mention of economic headwinds, it just cemented a decidedly dovish stance from the Fed in the market's eyes.
Makes sense.
It strengthened expectations for near-term rate cuts, easier monetary policy, reinforcing that idea the Fed was likely to prioritize supporting growth and employment.
So the Fed's dual mandate jobs and prices, the job side, was looking weaker.
That's how the market interpreted it, yes. Giving the Fed justification or maybe cover for rate cuts.
And that dovish tilt, fueled by those numbers, certainly led to some truly dramatic intraday moves, especially last Friday, September 5th. Wow.
Yeah, Friday was wild.
I mean, the morning session saw that sharp sell-off across equities.
Yeah.
Felt like, well, pure panic initially, driven by those weak jobs numbers and immediate fears of a slowdown.
Risk-off sentiment took over.
Totally. Investors rushed to safety, hitting the sell button hard, sending stock futures sharply lower even before the opening bell. And the bond market,
Did move there, too.
an immediate surge in demand for U.S. Treasuries, which, as we know, pushes yields sharply downward.
Right. Price up, yield down.
Both the 2-year and 10-year Treasury yields fell to multi-year lows. That just further cemented those rate cut expectations we were talking about.
Absolutely. It was quite the morning. Almost felt like a mini flash crash in some corners, as you said.
Yeah, exactly. But then things changed.
They did. And what's fascinating here is the market's rapid recalibration. It went from weak data is bad for the economy to weak data means the Fed will cut rates, which is ultimately good for equities.
The classic pivot. Bad news becomes good news.
It's a classic pivot, exactly. And it tells us so much about current market psychology. As the markets had a few hours to digest the full implications, that initial panic started to fade. It was replaced by this growing optimism about impending lower rates, lower borrowing costs, and the positive impact that could have on activity.
So hope for cheaper money, essentially.
Basically, yes. This shift from fear to, let's call it Fed put hope, helped fuel a broad rebound across equity markets by midday, recovered a good chunk of that morning plunge.
So it wasn't just digesting the news. It was this expectation that the Fed would step in.
I think that's a huge part of it. It reflects a market that has almost come to expect the Fed to act as a backstop. It fundamentally shifts how investors weigh negative economic news. It's like the market has this internal algorithm. Economic wobble. Anticipate cheaper money. Stocks benefit.
That's a great way to put it. That kind of pivot is really something. And it wasn't just a broad market recovery either, was it? We saw some really nuanced, sector-specific movements on Friday.
Absolutely not uniform.
Right. It wasn't a case of all boats rising together. In fact, rate-sensitive areas like home construction, small caps, even certain parts of tech showed, well, remarkable resilience. They often led the rebound.
That makes sense. Sectors anticipating lower mortgage rates, for example, found support. Lower borrowing costs help housing demand.
But other sectors, maybe more tied to just general economic growth, didn't bounce as hard.
Exactly. Think about maybe industrials or materials stocks. While lower rates help them eventually, their immediate fortunes are more tied to demand for physical goods, big projects.
Okay.
So if the jobs report sparked those broader slowdown fears, those sectors might have lagged a bit, even while rate-sensitive tech or housing surged on the rate cut optimism.
That dispersion is really important.
It is. It shows how different parts of the market respond differently or interpret the same signal differently. And then you had specific company news, too.
Like Alphabet.
Exactly, like tech giant Alphabet. It actually surged around 9% on Friday, but that was on very specific news, avoiding significant antitrust penalties.
Ah, so idiosyncratic news cutting through the noise.
Precisely, a unique positive catalyst. So the bottom line for Friday was a day that really showed both that initial fear and then the rapid recalculation. And sector dispersion played a key role, as some areas were just much better positioned for anticipated lower rates.
It highlights that even in a big market move, you gotta look under the hood.
Always. Understanding those nuances is critical.
Yeah. Okay, so beyond the immediate stock and bond drama here in the U.S., we should probably expand our view a bit. Look at the broader canvas commodities, global factors. They often tell a different story, or at least add another layer.
Good idea. They definitely do.
Let's talk oil first. Brent crude, the global benchmark, settled near $65.50 a barrel. WTI, the U.S. benchmark, around $61.87, seemed pressured by those growth concerns, right? And supply expectations.
Yeah, definitely. Global growth worries tend to hit oil demand expectations.
But then, on the flip side, gold. Wow. Prices surged dramatically, climbing above $3,590 an ounce. Record highs.
Record highs, yeah.
Quite a contrast, isn't it? Softening oil, soaring gold.
It truly is a fascinating divergence, and it raises that important question. How do these global cross-currents, geopolitical instability, trade tensions, how do they interact with domestic economic data like the jobs report to create such different moves in oil versus gold?
So what drove gold so high? Just the Fed easing.
That was a big part of it, for sure. Lower potential yields on bonds make non-yielding gold more attractive by comparison. But it wasn't just that. Gold's record run also reflected those persistent, broader global drivers, ongoing trade disputes, general geopolitical instability, which seems constant now,
Always something.
and the continuous shadow of the Ukraine war. All of these factors just reinforce gold's appeal as that classic safe haven. When people worry about the world, they tend to look towards gold.
Okay, so a mix of Fed and fear driving gold. But Why didn't oil get a similar safe haven bid with all that uncertainty?
That's the interesting dynamic. It suggests that for oil, supply expectations, maybe from OPEC Plus or other producers, and those broader global growth concerns were just more dominant factors.
So demand worries outweighed geopolitical risk for oil.
It appears so. The market was essentially saying, even with global tensions, if the world economy slows down, oil demand is going to drop. And that seemed to outweigh the kind of safe haven demand that boosted gold.
It's like they're pricing in different kinds of risk.
Exactly. Gold's surge screams systemic risk, geopolitics, inflation hedging. Oil softness whispers economic slowdown, especially on the demand side. The market's clearly weighing two different potential crises at the same time.
So as last week wrapped up, the overall market tone was this fascinating, almost paradoxical mix. There's underlying optimism based on expected Fed easing.
Yep, the rate cut hopes.
Yet still these persistent headwinds, inflation risks, ongoing geopolitical stuff. It's a really delicate balance, isn't it? A constant tug of war.
Perfectly put, a real balancing act.
Okay, so with that roller coaster behind us, what's on the horizon? Because this coming week, September 8th through the 12th, 2025, it's shaping up to be just as impactful, maybe even more so.
Feels that way.
We're guiding you through some absolutely crucial U.S. economic data releases. First up, we've got the Producer Price Index, PPI, on September 10th. That's inflation from the supplier side, right?
Correct. Wholesale prices, essentially.
Then the one many are calling the big one, the Consumer Price Index, CPI, on September 11th. That's inflation hitting us, the consumers.
That's the main event for many.
Also on the 11th, we get real earnings. And then finally, the preliminary University of Michigan consumer sentiment on September 12th.
A busy week for data watchers.
No kidding. Given all this, I imagine the market is really holding its breath for what's coming next week, especially that inflation data.
You're absolutely right. These reports aren't just numbers on a screen. They are the most market-sensitive reports right now because they directly influence inflation expectations and, critically, the Federal Reserve's policy stance.
Right, ahead of that big FOMC meeting.
Exactly. All eyes are on the September 16th to 17th FOMC meeting. And out of all these data points, the CPI report on Thursday, September 11th, is unequivocally the pivotal report of the week.
The linchpin.
It really is. Its direct impact on inflation expectations means it holds immense sway over market sentiment and ultimately what the Fed might do next.
Okay, so let's game this out. What are the scenarios?
Well, let's consider the three primary scenarios for what this inflation data could show and the likely market reactions. Okay, first, if inflation comes in higher than expected, a hot PPI-CPI reading.
Okay, hotter than expected. What happens?
Equities, like the S&P 500, NASDAQ, are highly likely to sell off. Investors would quickly unwind those rate cut bets we talked about. They'd worry the Fed might be less aggressive in cutting rates.
Or maybe even have to hike eventually if it's really hot.
Potentially, yeah. Or at least push back the timeline for cuts significantly. This would particularly hit growth stocks whose future earnings get discounted more heavily when rates are higher.
So basically, hot inflation means those dovish bets get unwound fast. What about bonds in that scenario?
Good question. For bonds, yields would likely spike higher, especially on the short end, like two-year Treasuries, as markets reduce expectations of those imminent rate cuts. Higher inflation usually means the Fed needs to keep rates higher for longer.
And the dollar.
The dollar, measured by the DXY index, would likely strengthen. Tighter perceived monetary conditions tend to boost the dollar.
And sectors most at risk.
Growth stocks, as mentioned, and those rate-sensitive areas, housing, real estate, small caps, utilities, they'd likely underperform as their business models are pretty vulnerable to higher borrowing costs.
Okay, so hot inflation sounds like a clear negative for most risk assets.
Yeah.
What's scenario 2, the middle ground?
Second, if inflation matches expectations, an inline reading.
So, no big surprise.
Right. In that case, equities would likely remain pretty stable, maybe modest gains. The market would largely hold on to the assumption that the Fed will cut at least 25 basis points in September, kind of a steady-as-she-goes outcome.
Okay, bonds?
Bonds would likely see yields stay fairly steady, limited volatility, because current pricing already reflects that expectation.
Dollar.
Neutral to maybe slightly weaker, as that anticipated 25 basis point cut is probably already baked in.
And sectors.
Tech and cyclical stocks could hold their ground. Basically, everyone waits for the Fed meeting without a major new catalyst pushing things dramatically either way, a holding pattern, like you said.
Okay. And then, the scenario the bills are hoping for. CPI, cooler than expected.
That's where things could get really interesting for the bulls, yes. Third scenario. If inflation is softer than expected, a cool PPI-CPI reading.
What happens then? Rally time?
Equities would likely rally, perhaps strongly. This is where markets would start pricing in a more aggressive Fed rate cut. Maybe even that 50 basis points we mentioned earlier becomes more plausible.
Because the Fed has more room to ease.
Exactly. The central bank would have clear justification and room to ease policy more aggressively. Bonds would see yields drop sharply, particularly on the short end, reinforcing those dovish expectations.
And the dollar weakens.
Yes, the dollar would likely weaken as rate differentials move against it.
Yeah.
Makes dollar assets less attractive if U.S. rates are cut more aggressively than elsewhere.
And the winning sectors.
Again, those rate-sensitive sectors. Housing, real estate, small caps, and growth-oriented tech. Lower rates make borrowing cheaper, stimulate activity, and boost the present value of future earnings. It's basically the inverse of the hot inflation scenario.
Makes sense. Now, beyond the big inflation numbers, we also have consumer sentiment and real earnings this week. How do those fit in? Are they secondary?
They provide crucial supporting context, I'd say. They're not the main event like CPI, but important. Stronger readings there, consumers feeling confident, wages keeping up with inflation that would support a soft landing narrative for the economy.
Which is generally good for stocks.
Generally favors equities, yes. It suggests the consumer is robust enough to keep things going without overheating inflation. Conversely, weak readings.
More recession fears.
Exactly. Weak readings would reinforce those recession fears we touched on earlier. That would typically boost bonds and gold as safe havens as investors seek protection from an economic downturn.
So CPI is the main driver, but these add color on the consumer's health.
Precisely. They influence how the market interprets the broader economic trajectory alongside the inflation data.
So what does this all mean for you listening this week?
Well, it means understanding these specific scenarios isn't just, an academic exercise. It's pretty essential for anticipating market movements in real time. The bottom line for the week is that the market will likely stay incredibly volatile and data-driven.
Every release matters.
Absolutely. Traders will be continuously repositioning ahead of that highly anticipated Fed meeting in mid-September. Every data release is a potential pivot point. Being prepared for these different outcomes can help you make sense of the headlines and the market's seemingly chaotic shifts.
Wow, okay. What an intricate week it's been, and what an impactful week lies just ahead. As we wrap up this deep dive, let's try to distill what we've learned and what it means for you navigating the days ahead.
Good idea.
We've delved into the profound impact of last week's weak August jobs report, how it really cemented the Fed's dovish leanings in the market's view. We saw Friday's dramatic intraday swing, that panic to optimism move, all based on evolving expectations for what the Fed might do.
That pivot was key.
And now, we're looking squarely at this coming week's pivotal economic data, especially CPI. It really holds the key to the market's immediate direction and ultimately, the Fed's next moves.
That dynamic interplay incoming data versus the market's evolving Fed expectations that will undoubtedly continue to be the primary driver of market behavior.
So being informed is crucial.
Absolutely. Being informed about these connections, understanding the if-then scenarios we've laid out, is really key to understanding and navigating the current volatility. It's like having a map for a landscape that's changing really fast.
Definitely need a map right now.
And maybe here's a thought for you to chew on as we finish. Considering that gold hit record highs last week, driven by both Fed easing expectations and that broader safe haven demand from geopolitics and inflation risks.
Right, the dual drivers.
How might a significant, unexpected shift in either global stability or future inflation data independently impact the market's trajectory? Could one of those factors perhaps even overshadow the Fed's immediate rate decisions for a time?
That's interesting. Like, could a major geopolitical event make the CPI number less relevant for a day or two?
Potentially. It just highlights how you need a multifaceted approach, looking beyond just the Fed, to truly grasp all the market dynamics at play.
Fascinating stuff to consider as we move forward. Thank you for joining us on this deep dive into the markets. We really hope this has equipped you with some valuable insights to navigate the days ahead with maybe a bit more confidence.
Hope it helps.
And just one final reminder. This content is for educational purposes only. Please consult with a professional before making financial decisions.